Big question. So, are we in a recession or not? One central bank official doesn't seem to care about the language all that much. The Minneapolis Fed's Neil Kashkari told CBS we have a long way to go in bringing down price pressures, and whether we are in a recession or not doesn't change my analysis. That from Kashkari. So let's get into all of this with Dreyfus and Mellon Chief Economist Vincent Reinhart. Vincent, what is your expectation? What is your take? Do you believe the words of Kashkari? And I guess to the question that we raised at the top of the segment, are we in a recession or not?
So two parts to the question. Will it matter to some Fed officials that we're in a recession? No, not at first, but the longer it gets, the harder it will be on them. And there'll be other Fed officials who are much more sensitive. The fact is that the Google search inquiries on recession are going up to match that on inflation. That's the first part. The second part, are we in a recession? Well, we hit the journalist definition, 2 quarters in a row of negative GDP. That's not that serious. The issue is many of the other measures of economic activity are actually pretty robust. Chair Powell was pretty explicit at his press conference just last Wednesday that we weren't on a recession. That part doesn't really matter. The economy's slowing, and inflation is still too high for the Fed. They got to be firming for a while. The recession call is going to matter when political pressure starts mounting on the Fed later this year, next year.
Vince, the market has started to already push back that we will see a 75 basis point rate hike at the Fed's next meeting. Do you think that's the right call?
It depends. Are markets right to be guessing what Chair Powell's probably going to do? Yes. Is 75 the right thing to do? Not nearly so clear to me. Last Wednesday at the press conference, Chair Powell is pretty accepting of current market pricing, and that basically said that the last summary of economic projections they put out, the dot plot, was about right. He also noted if that's about right, they got to slow the pace of tightening sometime soon. Next meeting sounds like sometime soon, and that's appropriate. Is that the right policy? Probably not. As they, a nominal federal funds rate of 2.25 is still negative in real terms once you subtract off inflation. They've got a big inflation problem, and they still have accommodative policy. They're going to have to do something hard, actually tighten financial conditions. It isn't working according to their playbook to firm the policy rate and see financial conditions ease, and that's what's happened.
Vince, at the same time, we've already seen, I just mentioned what's going on with that ISM report. Prices do seem to be, wavering a little bit, not necessarily staying at the high level. So there are some mixed signs at the very least here. So does that show that, well, maybe it has nothing to do with the Fed that the prices are coming down. Maybe it has more to do with what's going on the commodity side of the equation. But are we seeing a little bit of relief on that front?
There's a big chunk of price developments that have nothing to do with the Fed. That's the relative price change. Energy relative to the consumer price basket, commodities, important foods relative to other good prices of other goods and services. Fed can't pump more oil or harvest more wheat. What they do is affect aggregate demand. Fed's problem is they were too accommodative to aggregate demand up until now, and that is putting general price levels pressures on the general price level. That's what's the Fed's problem. You're reading the ISM right. Prices paid is very energy intensive, and it's come down a lot. That does probably say we're at a peak of inflation, but being at a peak of CPI inflation above 9% is no trophy. Even if we come off some, it's still going to be well north of the Fed's goal. That's the Fed's problem. But activity is slowing. You are right. Employment below 50. New orders, which is the part that's predictive in the ISM of future activity, below 50. Remember, this is a diffusion index. A reading below 50 means contraction.
Vince, you mentioned political pressure on the Fed rising. Now, do you think that pressure will be so intense next year that that might push the Fed to start cutting rates or pause? And I understand that the Fed and government are separate entities, but still, they're likely to feel the heat.
They're separate entities, but they both have offices in Washington, D.C. There's two parts to that. The one is the Fed is supposed to care about employment. The Fed's supposed to care if the economy is in recession because Congress gave it a dual objective: maximum employment and stable prices. Right now, when inflation is so far above the goal, it's obvious that the Fed's got to be worried about inflation because inflation is well above goal and employment at or above maximum. But 6 months from now, 9 months from now, when inflation is coming down and the unemployment rate is going up, the Fed rightly will be more concerned than it is right now about unemployment. Keep on top of that political pressure, and political pressure is also known as constituents pressure, i.e., pressure from voters, pressure from citizens. They're the ones who the Fed ultimately reports to. People will be concerned about employment. The Fed's going to be concerned about employment. Politicians are also going to be concerned about interest costs. When Paul Volcker started raising interest rates back in '79, the government debt was 1/4 the size of nominal GDP it is today. And he still ballooned how much interest the federal government had to pay. Jay Powell could do the same 4 times more because the debt to GDP of the government is 4 times where it was when Volcker started raising rates.
Okay, so Vincent, can you clarify that for me just a little bit more here? Does the midterm election then, given the political pressure that you were mentioning, does that have any influence at all on what the Fed's decision will be after November?
No. I think the Fed studiously avoids talking about politics within the room. It, however, seeps into the atmosphere in Washington, D.C. So the right answer is no, it's never part of their active deliberations. Yes, it's something they got to think about, in the background. It also influences what's in the newspapers, what you're reporting on your shows, and what the Fed Reserve officials hear when they go out to talk to people later this year after the midterm elections. The economy will probably have a higher unemployment rate too, and inflation will be off its peak. Those will be changing the calculus of the Federal Reserve.
Vince, in your note reacting to the Fed last week, you talked about how one of the perhaps mistaken propositions underlying what the Fed did, or what people are talking about generally, is that recessions are not messy. Are we being too complacent about a potential recession? And what do you mean by messy in this case?
Yeah, so I actually make a couple points. The first is, we had 2 quarters of negative real GDP. That's how we opened this segment. But other activities are pretty strong. The arbiters of the recessions, the NBER dating committee, isn't going to call a recession based on the recent data. But, if the economy does soften later this year and into next, and there is a deep, diffuse decline in activity, I wouldn't be surprised that they actually pushed the start of the recession to the end of last year. So we might wind up being in one of the longer recessions on record. Lots of reasons to think it won't be deep. Recessions, purge excesses in the economy. We haven't built up a lot of excesses, but they're always messy. We're going to learn something about somebody's balance sheet. We don't know who that is, and we don't know what we'll learn, but it won't be pleasant. That happens every time. Meanwhile, we're just U.S.-centric right here. Major economies are also triggering flags of recession, and emerging market economies are under enormous pressure, and even more so when U.S. interest rates rise some more. They've been coping with appreciation, or rather depreciation of their own currencies. It's going to get more complicated for them. There's going to be a lot of sovereign default. Add up increases in unemployment, poor earnings, a higher interest rate, and default experiences abroad. I don't see how that can be, not messy.
Real great analysis here for us. Vincent Reinhart, Dreyfus and Mellon, chief economist. Always good to see you. Have a great rest of the week.